So good morning, everybody. We'll start again so we don't get too far behind. My name's Franklin Allen, and I have the great pleasure of working with Trish in organizing this conference. And the centre that I'm director of in London is the Brevin Howard Centre at Imperial College. And we do most of our events in London, but it's a great pleasure to do this one in New York. And I think going forward, we can hopefully do more of these joint events and move them back and forth, because London and New York are the great financial centres in the world now. And a lot of the things that we discuss are very much between the two cities. And it's an interesting point that with Brexit, I was giving a talk in Paris a few months ago, and I was making the point that the Europeans seem to want to try and change and move things to continental Europe with Brexit. But in fact, given that many of the things that they're kind of talking about moving will probably be automated fairly soon anyway, and given that the technology is changing and so forth, it may well be that New York is the biggest beneficiary of Brexit rather than Frankfurt or Paris or Amsterdam or any of the other cities. And I think the agglomeration effects, and particularly between the two, are just huge. So I hope this will be the first of a number of these kinds of events. So for the second session, having done the history and got some kind of historical perspective about how things played out after other historic financial crisis, what we're going to do in this session is move into the more recent past and talk about two of the great framers of financial structure and things going forward, which is technology and politics, and the effects those are having on the markets, the regulation, and so on. And clearly, with Brexit vote and with the election of Donald Trump, there has been a big change, and these changes are also in other parts of the world. People, I think, thought with the Dutch election and the French election that there had been some kind of stop put on it. But what we see today with the recent elections in Austria and in Germany and so on is a continuation of populism and some of the undercurrents that seem to have come from the financial crisis. So we have four very excellent speakers, and they're going to be a mix of these topics that we're talking about in terms of technology and in terms of populism and the factors. So I'll turn it over. We're going to go in alphabetical order.
Thank you very much, Franklin, and thank you to Trish and all the organizers here. I was really excited when I heard about this conference, because something that has interested me a lot of late is the potential impacts of populism on financial markets and on the broader economy, for that matter. So I was very excited to see a conference that actually had the word populism in the title, along with finance. Let me assure you, by the way, I only have 3 or 4 slides here. The only reason I even went with slides is some of what I'm going to talk through is just easier if you can see it in list format. Because the genesis of this, first of all, I'm going to shamelessly plug this paper, which we have a bunch of copies of back by the door, Financial Institutions in Age of Populism, which encapsulates a lot of the thinking that I've come to about the interaction of populism and financial institutions, hence the title. The genesis of this paper is that I've, over the past couple of years, been spending a lot of time talking with policymakers and people in the private sector around the world about what I see as a quite significant tail risk, that the next decade will see a lot more impact of populism in the developed economies than we've seen for many decades. And not being a populist, I tend to see this in negative terms. But in either way, whatever your view, I think that this is likely to produce very significant changes from the environment that we've instinctively taken for granted. Basically, if you've experienced one environment for your entire adult life, there's a very natural tendency to assume that is a universal truth and not just something that happened to be true for 30 or 40 years. It's one reason we have eminent historians, as we did earlier today, to help us to look beyond that. But it's still hard to break out of that. So I started looking around, talking with people and looking in the literature, and I find almost nothing out there about if we enter a period of this kind of populism, what does it mean if you're trying to run a business? And in particular, I focus on financial institutions at Oliver Wyman. What would this mean for financial institutions? So what this paper does is to put together a set of implications that I think are likely if we find ourselves in that environment. I'm going to stay away from much talk about what the probabilities are or what forces might make it happen or not, and simply focus pragmatically, if we find ourselves in this environment, what does it mean? But I do have to start with one quasi-theoretical point, which is people use populism in very different ways. So what is it I mean in the context of this paper? So I focus on 5 characteristics. First, populism involves a rejection of the elites in favor of the people. Now, the people can be very broadly defined as everybody but some obvious elite, or it could be, say, defined as French people who have grown up from historically French families. You can have other narrower definitions, but certainly it's the elites versus the people. Here, you don't have to have nationalism with populism, but you almost always do. And in what the kind of environment that I'm looking at, they would come together. So there'd be a focus on national interests narrowly defined, and therefore a rejection of what we've tended to call internationalism. There's a rejection of existing institutions. They're viewed as either broken or rigged or both. There's a scorn for experts and therefore an embrace of common sense. And given these characteristics, there almost always comes with a desire for a strong leader to drive change. If you think the system is broken, it's awfully hard to get to where you need to be without that kind of strong leader who doesn't feel bound by traditional norms or structures. So that's what I mean by populism as I go through the rest of this. And this slide and the next one, what I simply did is I came up with 11 themes where I thought that the world in that populist environment might be very different from what we've experienced, indeed often diametrically opposed to what we've gotten used to. And I ended up breaking them into 4 larger categories, so 2 of them are on this page, 2 on the next. First, populism inevitably involves a politicization of national, and to the extent that it's a nationalist populism, of international affairs. So we've gotten very used to, in the West, having fairly distinct roles for business and government. Clearly, government has a regulatory role, a role in setting the broad framework, but we've gotten used to the idea that business is then allowed to operate fairly freely within that framework. Whereas in a populist environment, what you clearly see is what I'll call kind of bolt from the blue government demands. I guess I better mention Donald Trump immediately to make clear. I will use a few examples from President Trump and candidate Trump, but I do not think that Trump is primarily a populist phenomenon. So I don't want you to come away thinking that these themes I'm laying out, I think, are what we're going to experience under President Trump. But something he did illustrate as a candidate, especially right after election, was suddenly he would be attacking companies that were doing perfectly legal things, that, and particularly moving jobs offshore, that he opposed. And that's not something we've seen very often in a long time. You can go back to President Kennedy, and I think it was the steelmakers. Yeah, there are a few times in the past, in recent decades, but you don't see a lot of that. Whereas if you look at, say, Argentina under Perón, you get a lot of that sort of thing. And again, it's not just demands, it's also favors. If you're on the right side of the new regime, it can, at least in the short run, be a very good thing for you. We've had, and people might argue with me, but I would submit, we've had a great deal of political stability in the West for decades now. In a populist environment, you'll have a lot more political risk. You'll have it for several reasons. First is, anytime you get an insurgent force taking over, the rules change, you don't know how things are going to work out, there's a lot more volatility, and you don't know who's going to be in charge within that new group. But beyond that transitional effect, populism doesn't tend to come with a deep set of beliefs other than these more emotional kind of approaches that I've talked about, the people versus others. Sometimes it may hook up with some other deeper ideology, but often not, which also means it can end up flipping around a lot. They try a policy, it doesn't seem to work, they move on to another policy. So political risk becomes bigger. We've gotten very used to the idea that Western countries don't go to war with each other. This isn't necessarily true in a populist environment like I'm describing. Now, hopefully we'll avoid outright war even in that environment, but something you easily could see is a Cold War. And if you think about the Cold War we experienced between the West and the Soviets, you bring that to today, there's going to be an immense amount of cyber war, because that's an obvious way to not directly use military force and yet to try to make the other side submit to your will. It's also much more deniable. So I would worry about that. And there, by the way, financial institutions would be the innocent bystanders sitting in the middle who would be suffering a lot of these attacks. Fourth one, in terms of politicization, central banks have never been completely independent, but they've had quite a lot of independence in the West, and increasingly of late, at least until the financial crisis. There is no reason that populists would keep that going. Basically, central bank independence is based on an assumption there's economic theory that can lead you to the right choice, and that there's a set of people who are experts who are willing and able to represent the public interest in applying that. And populists will not believe either of those things. And I think you'll see this more broadly with independent regulatory agencies as well. All right, more volatility. Well, institutional stability is clearly going to go by the boards. Populists come in with the idea that the existing system is radically rigged or broken, and therefore they will change institutions as much as they are capable of doing, certainly if they're effective, and so you get institutional instability. We've had relatively predictable economic policies for some time now. You understood the broad framework, at least, of it. Populism doesn't tend to come with deep and sensible economic policies, so you don't quite know what they'll do, and it's likely to change if it doesn't work out immediately. All of these things mean that the relatively stable financial markets, and you can argue about how relatively is, but I would certainly expect a lot more instability because the unstable economics and the unstable politics will be reflected in market conditions. There are a couple things I group under major changes in economic conditions. One is, I would argue that we've gotten used to really low expected real returns for some time now. But if you're in the market in this environment with all this instability, at some point you're going to demand a lot higher real return for actually taking risk. So that could go up. And something I'm pretty much dead certain on is populists do tend to lead to higher inflation, particularly when you're almost as low on inflation as you can get right now anyway. So you could see real risks there. And of course, the kind of nationalist populism I'm talking about, you get less international cooperation, more expressions of national sovereignty, and the expansion that we've gotten used to of trade and cross-border investment, as Michael was talking about, there's at least a slowing and quite possibly a contraction of that. So I assert that these 11 themes are quite possibly things that would reverse significantly. I've not seen a lot on this, as I said, so I would love feedback from people. I put out my paper in March, and I've gotten some comments. I'd love to hear more. And the paper also has a lot more about what I mean by these things, what I think the implications would be, and what it means if you're a financial institution, how you might think about all this. So thank you very much.
Okay, so thank you. I think I'm going to challenge some of the previous assumptions. And I'm going to say that politicization has been a key driver of financial regulation and some of the global tenets of financial regulation for quite some time. And it may indeed have been one of the primary causes of the financial crisis. And we can see this in a lot of ways in data not only in the way in which we design financial regulations in the US, but also in the types of ways in which we see different types of, or interest groups, a variety of interest groups, impacting both legislators as well as the regulators themselves. And also, there are different means of populism in the sense of our institutions, of which allows, even if you can have dynamics in interests and preferences and so forth moving, our institutions are means of aggregation, and to the extent that they allow certain interests to express those interests at various times, they act as ways to, I would say, slow down a lot of those pressures. So we have a lot of checks and balances that mitigate. Other developing countries don't, but we'll see. So we're going to look just at the US in this particular case. And there are ways to extrapolate and to understand this, especially in the European context where some of this has been done. Katerina has been looking at some of this, so she can speak to some of the questions there. So let's just start. There's the way in which we think about this in the regulatory and the financial crisis way is really a notion of regulatory failure, and the sense that many regulators did have the authority to oversee financial institutions that brought down the economy. And the debate really is whether over the institutions themselves were strong enough, and that, in fact, that regulators had sufficient discretion, that is, power to set authorities to respond to unforeseen conditions, to react to the needs of the economy, the businesses, and the different parts of the economy that they regulated, or in fact were they captured by the very parts of the economy that they regulated, and that they failed to use those tools that they had. Now, I mean, there's lots of theories that we can go over, and I'm not going to go into any of the political economy theories that are out there, but to understand some of those big themes that were being represented there are many hypotheses that get derived from those political economies, the ways in which preferences, how interest groups interact with legislators, agencies, the political dimensions of it, then, and under what conditions would you anticipate there to be change in policy. And so that's a humongous literature in the political economy, and I'm happy to direct anyone there. But this is just a way to start looking at the particular institutions themselves. And one way to grapple with that is to actually start coding laws. And in here, we're just going to give you a snapshot into a very large project that looks at all of US financial laws since 1950. And this is just one manual coding, and I've done this with big data, NLP, machine learning, all of that. But I just want to give you the manual coding spectrum of what we've done. And here, what we're looking at is just all laws, US federal laws that were passed since 1950. That will include banking, stock market, financial intermediaries, and all the way down the list. And then we're going to code for a bunch of pieces of information, the types of law that they were, the different types of agencies that were delegated to, was authority delegated to, how much authority was delegated to it, and so forth, was new agencies created, and then in addition to all that, all the procedural constraints that were associated with the use of that delegated authority. And from this, lots of calculations and so forth, you come up with a notion of agency discretion. That is the amount of authority agencies have to actually regulate the economy on a variety of different perspectives. Given that, then, in addition, there's tons of other data that are collected associated with this. Okay. And just to give you a sense of how much action is really done on regulating the economy, so this is really not something that Congress or the legislator only thinks about every once in a while, so it's not just a regulatory action, it really is a legislative action. You see that, in fact, there are a considerable amount of laws that are constantly being enacted over this time period. In fact, there are about 3.5 pieces of major legislation that are being acted, and you see that it's not just a result of unified or divided government, Republicans or the Democrats, but it really is done under both particular times. In addition, you can see that there are a number of interesting patterns. So if you look at just the relationship between the rise of the financial sector and the amount of authority that is delegated to the agencies, you start seeing that over time, that as the financial sector grows as a larger share of the overall economy, the agency's discretion to oversee that part of the economy is actually declining. And so what would be some of the causes of this decline? And we can see that, well, yes, the delegation has fallen off, especially around the end of the Dodd-Frank, and so delegation has fallen off, especially around Dodd-Frank and that area. But we also see that's really driving is the constraints, that is the procedural constraints that the agencies have to actually use their delegated authority. That is, it's even if you think that regulators are going to be able to regulate, they're now subject to a lot more procedural hurdles. That is, there are a lot more places where political actors can get involved in the regulatory decisions. There are lots of places where interest groups can get involved, where they can be pressured and so forth. Moreover, you see that the authority is being spread across the number of agencies. That is, the ability of any one agency to act is being diluted, and that there are what we call overlapping jurisdictions and checks and balances. So it becomes even more difficult for the regulators to enact the authority to act in an effective way. All right. In addition, you can see that where the authority is being delegated, that is becoming increasingly politicized. And this is just a way for thinking about this. That is, the authority that's being delegated is moving out of the independent agencies, the SEC, the CFTC, and so forth, and to the more political agencies. That is, the agencies that are from appointed heads, the Treasury, and so on. Okay? And that is, the agencies that have the authority to regulate are less independent than they had been previously. All right? Given this, then, just on the regulatory side, just the way in which we think about the structure of government, the structure of financial regulation over time, we see a number of important trends. First, Congress has continued to pass important laws regulating financial actors over this entire period. So it's not just a now's new phenomena. Executive branch officials do possess an enormous amount of authority to actually regulate along a very broad span of the economy, and they have discretion to do so. But in fact, a lot of what's happened over time is that this delegated authority has changed, and it has changed in an interesting way. Authority has become more constrained by administrative procedures. It's been a split among more actors. That is, there are more veto gates, political veto gates, and it's been invested in agencies that are under more political control as opposed to independent regulatory commissions. To give you also a sense of what this now means when we think about access of interest groups, other types of parts of the economy, or different types of you think of populist movements, you don't always think of them as organized interests, but they could be. They could very well be highly organized interests. But usually you think of, in the case of financial regulation, it's really a case where the benefits are very specialized, they go to large industries, the costs are highly dispersed, so any one person who's actually now going to have to pay an extra $5 on their deposit account is less likely to mobilize. So this usually creates this asymmetry in the interests of different parts of the economy, different parts of political actors to lobby Congress and regulators. And this is, over time, what we have seen in the differences of the pressures that happen within regulators. And just to give you a sense of that, I just want to show you the data of what we're looking at. So this is the data that I'll show you, which is lobbying data that will be done at the legislative stages, and this will be going to members of Congress on key committees. And I'll show you some of the administrative stage, that is lobbying. You don't lobby in particular, but you access the number of times you meet and talk to regulators at the administrative stage, okay? And so here you can just see that total lobbying was going to peak around Dodd-Frank, so clearly when good things are happening, they're active and interested, and then it'll fall off. So this is a purpose and strategic-minded way of doing things, that insurance and security and investment industries are some of the largest donors in that financial sector. We see commercial banks, security and investment firms, credit unions, again, are in the financial sector. And then when we look at the administrative stages, that agency contact, and it's looking at, you see the SEC and the CFTC are lobbied most frequently. That means the number of contacts as compared to the OTC and the OCC. And you look at the number of clients that lobby the agencies. Again, you see that is separate individual clients, not just that JP Morgan keeps going back and says hi to the same regulator, but the different individual clients. You see again that the CFTC and the SEC are lobbied most frequently. And in addition, that you see that the SEC and the CFTC have the clients that have the deepest pockets. So this is just a notion to start seeing that not only is the design of regulations themselves highly political, but how those regulations are implemented and used are also regulated when we see it both the legislative arena and in the administrative arena as well. So just in the findings then of some of the data that we're looking at is this lobbying across agencies differ, and it's very strategic. You could see spikes around, in this case, highly political areas, like in the Dodd-Frank. At the aggregate level, lobbying at the administrative and legislative areas are highly correlated, and legislative and administrative lobbying can be seen as substitutes or complements, but it's not clear under what conditions yet they are. And then when we just think of some of the reforms, right, you just want to see within the debate, yes, they have a lot of authority, but they're hamstrung. And it's really a political process, and it's being driven, and over time it's being driven by political issues, whether that's populism, whether it's just interest groups, what have you, but it has significant impact. And then you need to realize when you're doing these regulations to make regulations resilient to these types of lobbying, both at the legislative and the administrative arena, and that this is putting the brakes on so that if you have big swings in opinion, you're still trying to be efficient in the way you regulate and adhering to good and best practices in that. Thank you.
Thank you, Sharon. Our next speaker is Gil Mondelsas. He's going to speak from the table.
Yeah. Good afternoon, almost. So I don't have slides, so I'll speak from here. I guess I'm on the ticket of a practitioner on the panel. And a little bit about me. About 20 years ago, I was about 20 years younger than I am today. And yeah, exactly. Well, almost. And I had the good fortune of starting a technology startup that was Silicon Valley funded, And it was basically a post-trade, think of it as a Visa network of foreign exchange transactions that became very successful, became basically a global market utility. Before I left it about 7 years ago, we were processing about $1 trillion a day. And were very prevalent in the foreign exchange market. But back then, there was a very rare phenomena that a Silicon Valley startup, not backed by the banks, not invented by the banks, not funded by the banks, was actually becoming something so prevalent and meaningful, because all of our competitors were very different. After 7 years, we successfully sold the company to ICAP, a London-based, at the time the largest interdealer broker in the world, both voice and electronic processing, and I took over ultimately the electronic platforms running both the world's largest foreign exchange trading platform as well as the largest foreign exchange fixed income trading platform, EBS and BrokerTec respectively. And in that sense, those were platforms that were set up by the banks as consortia, funded by the banks, ultimately sold to ICAP. In that context, running meaningful infrastructures, private sector run, but meaningful infrastructures. I sat on the FedFX committee with Trish, and the Bank of England FX committee, and the Bank of Canada, dealt a lot with Treasury, Fed Washington, et cetera. So always was on the intersection of sort of public policy and market structure and infrastructure. So, and about a year ago, I left to start a new company, and I'll talk for 2 minutes about it, because it's a very different experience starting another infrastructure company in this day and age, given the context of market structure and where it's going. The trend for the last, I don't know, many decades, if not hundreds of years in the financial sector from a market structure perspective, from my perspective, was very consistent in that the banks and financial institutions made their money trading. And it was all about being able to capture as much of the flow as possible and make as much money as possible. And for that purpose, banks gave pretty much everything away, pretty much for free, to just make sure that they get the flow. So they built technology, they provided great research, they provided great coverage, they provided clearing, and by the way, they had huge balance sheets that they gave away that were either not appropriately priced or not priced at all. And that led obviously to consolidation in the industry because banks wanted to get those deposits, get more balance sheet, they can lever, that they can basically extend, and they can both trade them and extend them to clients to get more and more flow. On the back of the financial crisis, regulations were put in place, as we all know, to make sure that banks are never going to be bailed out again. And as a result, and by the way, those regulations were very effective in trying to shrink the bank, and that's what we're seeing. So the large banks that became huge and became so dominant, and the providers of infrastructure and trading and balance sheet to the world have started basically, we started seeing the shifting course, and they started shrinking. And the new regulations basically put the large banks in a box. So what we're seeing is that the large banks, from a balance sheet perspective, they're structurally disadvantaged comparing to other institutions, both smaller banks and people outside the industry. They cannot subsidize the technology, research, and other offerings, clearing anymore. Prop trading is disallowed. Differential client pricing, when we did I was a small part of the fair and effective work that was done by the Bank of England, as well as some of the work that was done on the global code in the FX world. Huge questions around how do you price and why do you price clients differentially. Banks want to stay away from that, so moving more towards agency models. It's harder to get banks together, actually, to just sit around the room and discuss markets, market infrastructure, very different to the world where the banks were really driving, the largest banks were really driving the innovation, the market infrastructure in setting up CLS, DTCC, EBS, BrokerTec, market, almost every infrastructure and market structure debate and discussion was led by the large banks leading into 2007 when we live in a very different world. And in the end, the large banks are now firing clients. They're not onboarding as many new clients as they used to, and they're actually restricting what their clients can do. So to me, we really are at a point, post the crisis of an enormous departure from everything, from the entire trend of potentially hundreds of years in terms of the structure of the financial markets. And I cannot overstate, from my perspective, how big this change is. I cannot overstate how big the void that's created in the market right now for all of these services, payments, technology, balance sheet, credit, etc., risk, how big the void is. And we simply cannot expect that this void is going to stay there for a long time. To be clear, I'm not projecting at all the demise of the large banks, quite the opposite. The large banks actually have assets that are just simply, you cannot rebuild the global reach, the technology, the coverage, being papered by gazillions of counterparties all over the world. It's impossible to create another JP Morgan, another Citibank, another Barclays, or any of those. There's somebody from Credit Suisse. I want to make sure I don't insult anybody. So it just simply cannot be replicated. So actually, for the remaining banks post-crisis, they have a huge role to play, and they're going to be very successful, uniquely successful. Competitively, they're actually exiting the crisis. They're probably in better shape. However, from a market structure and infrastructure perspective, innovation, funding, etc., I believe they're not going to be as meaningful, and they're not going to have the same role that they used to have. I have 5 more minutes, and it's exactly time to move for my second page of 2, so it's right on time. So the banks are not going to provide that, but at the same time, the true innovation, there is a lot of talk around fintech, and there's a lot of work that's being done around fintech the last few years. I believe that the true innovation, we actually haven't even started seeing yet in the market. Most of the focus over the last decade has been about first of all, just the shrinkage of the overall system, and people were playing more defense than offense. But also a lot of the innovation has been about the implementation of the existing regulations. So as the regulators are working, what does MiFID means? What does it mean to provide best execution? All kinds of, to me, utilities and RegTech that basically kind of implements what people were the regulations that were put in place. We're also at a local minimum in the history of financial services, in the sense that there is no economic growth globally, in the sense that there's no interest rate differential. So we're kind of converging around a local minimum. As growth will kick in the years to come, both overall economic growth, interest rate differential between countries, there's going to be more trading, and this is where we're going to feel the real void, and this is where we're going to miss I don't know how many banks that went out of business throughout the crisis. This is where we're going to feel that we do miss Lehman Brothers and Bear Stearns and Fortis and all of the to that basically either are no longer with us or are no longer in the business of providing balance sheet innovation and technology. To that extent, if we look elsewhere in the outside the financial world of where innovation came, and we look at mostly Silicon Valley by way of analogy, the biggest innovations came, say, the last 5 to 10 years. If you look at Uber, if you look at Airbnb, these are the biggest innovations that came out of the internet. They were actually invented 20 years after the internet started. And by the way, none of those innovations, big innovations that you think about from the internet, actually were technology innovations. These are business model innovations, not technology innovations. And all of a sudden, a company comes from out of nowhere called Uber and changes entirely the transportation industry. And Airbnb, which is funded by the same people who have funded Triana in the past and are funding my new company, Airbnb became the largest hotel chain in the world without owning a single hotel room. Completely changed that industry. And by the way, there are a lot of regulations in this industry too, and all of a sudden a player that's unknown, owned by people who don't reside in this industry, all of a sudden has taken over this industry overnight. As the large banks are basically fading away as the drivers of market structure and infrastructure, and as there are such big changes that are going to occur or that are occurring in this industry, I believe that the biggest innovations in the financial industry in the years to come. There's going to be big innovations and big disruptions, and they will come from non-traditional players. They will come from Silicon Valley, by the way, Silicon Valley, London, wherever it is, but it will come from venture capital and private equity-backed companies that will take all kinds of spin-offs from the banks or elsewhere. But it's going to be a completely different environment, a different set of players that are going to participate in the market. These players are going to be less regulated. These players are going to speak a very different language. They're going to be very commercial, very entrepreneurial, and this is going to be a big piece of the future. So if I look at the next 20, 25 years, I predict market structure is going to be massively different. It's going to be much more fragmented, led by many more commercial institutions. There's going to be a lot of good that comes with it, and there's going to be also meaningful pitfalls or challenges to the traditional regulators, to the traditional central banks in understanding what is going on, in following what this innovation is, how it impacts the market, and how to shape it in a manner that's going to be both productive but also healthy. So that is me. Thank you.
Thank you, Gil. Final speaker is Annalisa Ariels from Cornell Law School.
Thank you. So I'm going to take us back to the populism question. So just to put it back on the table, a couple of snapshots we could work with. So many people here probably remember that during the presidential campaign, Donald Trump famously declared that Janet Yellen should be ashamed of herself, accusing her explicitly of being partisan, politically partisan. And in so doing, he was building, of course, on the Audit the Fed movement, which united the far left and the far right in a sense that central banking is political and therefore should be under the control of the political branches. But long before that episode, long before what happened in the United States, of course, in Japan, we had Prime Minister Abe, a nationalist politician who came to power on the promise to make the central bank heel. And as an anthropologist who works in Japan, I heard many, many people who I respected say, I don't agree with his nationalism, I don't agree with his politics, I don't agree with his militarism, but I may agree with his economic policy. And then, of course, in Europe, recently with Brexit, we all remember Mark Carney standing up and saying, I have a plan, and then being met with ridicule, people saying, the Brexit folks saying, we'd be better off with a Manchester football coach, this sort of attack on expertise, but also a sense that somehow the Euro project itself was a topic that, something that was politicized not just on the immigration side, but on the financial side. So we have a bunch of politicians coming to power on a nationalist political agenda that includes many, many things, immigration, nationalism, militarism, and so on, but also includes a promise to rein in financial experts. And it seems to me that it's quite obvious that we now have a massive crisis of legitimacy around regulation. Specifically around expertise in regulation. And this is not a small matter that we can just ignore. We know that there will be another financial crisis, and when there's another financial crisis, resolution will depend upon the legitimacy of regulators. And so this is a problem we actually need to address now. Now, the reaction of most central bankers and regulators, as I see it, we could talk about this, but is the proverbial ostrich in the sand, I would say. Janet Yellen has vigorously denied that there is anything political about central banking. In other cases, I would say in Japan, Mr. Kuroda, who heads the central bank, has in some respects seemed to enable nationalism by rendering the larger political project of Mr. Abe politically palatable. And in other cases, perhaps an example might be Mr. Draghi. We see an effort to craft an alternative political narrative to make a case for some sort of pan-European economic identity alongside a pan-European political identity, which is quite interesting. Now, I come at all this as an anthropologist and a lawyer, but an anthropologist first for the point of view of this conversation. And so I see this crisis of legitimacy as a problem of a clash of cultures, specifically expert cultures, and the larger public. And I say public here, not populist, because I think it's important to remember that there are many, many people who hold many, many different views in the public, even though they're not experts. And that all of us, experts and publics, are formed in our views by the cultural milieu in which we operate. Now, this clash of cultures, so these pluralistic cultures in our societies and our markets, have long been managed by what anthropologists would say is a kind of foundational myth. Now, myth, I think, in the popular sense, suggests something that's false. In the technical anthropological sense, it doesn't mean false at all. If you don't like the word myth, you could substitute political theory, if you prefer. But the basic idea is politics is some area where the public gets to take the lead. And then there's another sphere of governance that is purely technocratic or scientific, and that's where the experts get to take the lead, and each one has its sphere. And so this myth or theory is exactly what is being challenged in the current environment. This idea that certain things are purely technical or scientific. In other words, a sense that the public should get in on that space. Now, one of the things that anthropologists know about myths in all societies is that once they come under serious attack, it's very hard to rebuild them again. So once it's possible for a substantial number of credible people to stand up and say that there is no purgatory or angels, it's very hard to get the general consensus that there is a purgatory or angels again, although there will be some people on the fringes who insist more than ever that there are angels and purgatories. Most people will now buy into it. So this is serious, the situation that we're in. We need a new theory of legitimacy, a new way of engaging the public and figuring out what our division of labor or division of authority is. So I'm talking today about a book that that's coming out soon from Cornell University Press, in which I argue that we actually need to invest in a radical new approach to the politicization of financial governance policy. And it can't be resolved entirely with the little levers that we've used up to now, which is tinkering with the institutional framework for how central bank governors are nominated or confirmed, or how many times you have to report to Congress and so on. That appointment and oversight structure is no longer going to be enough. So what are the elements of a new approach? The first, I think, and this is probably going to be very unpopular in this room, so I'm sorry, I'm just going to say it, is to acknowledge that in some ways financial governance is political, in some ways. So what do I mean by that? Let me be very clear. I don't mean that it's partisan in the sense that it's purposely supporting one candidate or another, in the sense of Janet Yellen should be ashamed of herself. I do not mean that. But I do mean that it's time to fess up with the public about the fact that there are profound distributive consequences to what central banks do. And also to fess up with the public about the fact that that all technocrats, including financial regulators, operate in a political ecosystem. So they are beholden to politicians in certain senses, but they're also beholden to other political actors, like market participants in many respects. And that is a form of dependence, not independence. That is just a reality. And the third aspect is that while expertise is real and important and valid, it does not mean that it entails no value judgments. Indeed, that's why we want human beings doing this and not machines, right? And so that's I could give you some examples, but I'll pass. So. And then finally, I would say the final way in which we could acknowledge that it is political, and perhaps most controversially, is that sometimes financial governance has political effects. So I believe, personally, that the bailouts of 2008, and not just the crisis, set the stage politically for the populism that we face now. And likewise, in Japan, where I do my research, I think we could argue that Abenomics has failed as an economic policy, but it has succeeded as a political and cultural program that is one that empowers Prime Minister Abe. And so to the extent that these political effects of financial governance are foreseeable, it seems to me that policymakers are as good technocrats should take them into account. And certainly, to the extent that they're obvious to the public, they need to be part of a conversation with the public about how to rebuild our legitimacy. So that's point number one. The second point is, once we do that, would be to address the clash of cultures between publics and experts more head-on. And I see this as a problem not just for experts, but also for the public. The central bank community, or the community of regulators, frankly, as an anthropologist, I can say with authority, is a small village with its own rituals, gods, chiefs, and reigning ideas. And the question is, how does that village open up a little bit more to the outside world? Let me give you an obvious example from Japan. Inside the central bank, where I did some field work, one refers all the time to Mrs. Watanabe. Mrs. Watanabe is the archetypal retail investor. And the question is always, how will Mrs. Watanabe respond to this central bank initiative or that central bank initiative? And it always intrigued me that Mrs. Watanabe is nowhere to be seen. She is not invited to any conferences like this, nor would she be interested in coming. She's just a fictive figure. And the question is, would it be possible for central banks to engage much more actively, much more proactively with that public? And here I think methods from anthropology and sociology and parallel fields can really help to do that work. Not just for the scientific purpose of finding out what Mrs. Watanabe thinks, but for the legitimacy purpose of enrolling Mrs. Watanabe in the common political project of governing the economy. So the real message here is that communication and outreach needs to be a core mission of regulators, not something we sort of do on the side afterwards or what have you, but something as important as communicating with market participants, which is considered absolutely core to what regulators do. But on the flip side, there are also here obligations on the part of the public. The populist claim that financial governance is political means that the public needs to step up and take some authority for the quality of that, some responsibility for the quality of that politics. And I think that's what we're not seeing as much at this moment. The sense of, we all understand that our democracy is fragile and we all have to care for it and that we have civic duties in that respect. If there's also politics in this relationship with the market, that also needs to be part of the equation. And so then the real question is, what are the institutional mechanisms that allow the public and the experts to begin to have a more serious and fruitful and sustained conversation? And that's the question that I really focused on at the moment. And I think there are certain institutional and levers and inflection points in the existing system. Sharon was talking about increased reporting practices and other things, increased hoops people have to jump through and so on. These can be spaces which can be used to develop that relationship more. I think also stress testing is an interesting one. It's about communicating with the market. Could it be also about communicating with the public about the future of the economy? But the fact is we probably need something more, a larger platform for engagement, a space in which we can find ways of connecting and also recognizing the publics we're talking about are global publics. They're not domestic publics, but global publics. And so a space in which we can make those connections happen. And I think that would be a really interesting institutional challenge for us, perhaps one you could help us with, because it's a platform problem, basically. A question of how do you build a platform for that rich conversation between the experts and the public that produces the new legitimacy basis for governance of the economy. Thank you.
Thank you, Annalisa. So we've heard a range of different views on populism and its effects, and on technology and its effects. And let me start with a question. So clearly, pretty much everybody missed that the financial crisis was coming. The regulators did, the experts did. a few people studied crises, but they were very much in the minority. It was something that was regarded as either historical or something that some emerging economies suffered from. And so I think a large part of the problems is that fact that they just didn't know what was going on. And so then one comes to the question, so is it going to happen again? And so the usual claim is, well, no, we fixed the banks. They've got lots more capital now. We stress test. The regulators know what's going on. They do a much better job. And I think the problem is that systemic risk is a very difficult thing to understand, and it isn't just about banks. It's about the financial system as a whole. And I think one of the reasons history is so interesting is to see the different ways it happens. Now, my own view is that probably the weakest part of the financial system at the moment is arising from low interest rates. So if you look at the pension systems, they're in trouble. We have lots of evidence that fixed income is just not contributing very much because we have either 0.25 or 0.5%, or in many parts of the world we have negative interest rates. And then if you look at what's happening in the markets at the moment, pensions have been kind of buoyed somewhat by the fact that asset values are very high. So if you look at the US stock market, keeps hitting new highs all the time, and other assets are also very valuable. So the question is, what happens if we were to have a crash in the stock market now? What would happen? And it would be problematic because the pension funds would be in big trouble. And so far, that hasn't happened, but it would obviously have spillovers in a huge way into what people think about the way things are run and so forth, and the way regulators are done. And it plays into this issue about central banks and their effect on the world, and in particular on inequality and so forth, because we have seen that. So the standard defense that central bankers use, well, we're trying to help people who are unemployed and we're trying to get back to full employment. But UK has been the lowest unemployment for 42 years. It's quite low in many other parts of the world too. So the defense that we've got low interest rates to help the economy doesn't seem to sit very well with this fact that it's having great damage on large parts of the financial system. And this also relates to, I think, to some of the points that Gil was making about the change in financial structure, because with such low interest rates, it's very difficult to have the revenues that you need to maintain the financial structure. If your long-term bonds are making 200-300 basis points, there's not much space for charging 50 basis points or 25 to support the structure. So the question I would like to start with is what you each think of about this possibility of another financial crisis, and just to take as an example, what happens if pension funds and insurance companies and other providers of long-term assets that fund people's retirement, if that does get into serious trouble, and what would happen in terms of populism, in terms of market structures, and so on? Would anybody, Doug, would you like to start?
Sure, and if you don't mind, I'd also like to briefly respond to what Sharon was saying, since I think there might have been a misunderstanding of my points on political independence. Let me just say, as I alluded to briefly on central bank independence, I absolutely believe that so-called independent regulators and central bankers are deeply embedded in a political process, and they have effects on politics and vice versa. So I think both Sharon and Annelies have argued very well in terms of that. And I would also say I do very much agree with the point about checks and balances in the U.S. When I think about where the type of populism I'm talking about might have the most wide effects, I tend to think more of Europe than I do of the U.S., because we have a system here specifically designed to hold back populism, and most particularly to limit the ability of a demagogue to overcome the institutional barriers. So It's quite possible that Sharon and I disagree on the level of politicization of the process in the U.S. We'd have to talk about that more. But I maintain, even if that were true, moving to a truly populist environment would see a dramatic step up in the influence of politics, I think, on regulation. Anyway, just so there's no misunderstanding of my own personal views. In terms of your question, Franklin, first, I think probably everyone in the room would agree with me. We will have more financial crises. As long as we have humans in charge of the economy, or humans designing the programs which are in charge of the economy, we are going to have financial crises. There are inherent vulnerabilities. I personally tend to believe fairly strongly in the Minskyite view that, in fact, there are inherent instabilities in the financial system that you tend to overshoot in one direction or the other. One reason I go on at such length about that part is because I'm not actually terribly worried at the moment about the specific concerns you just raised. In large part because we're still close enough to the last major financial crisis that there's an immense amount of attention both in the public and the private sector to these various risks. Now, that doesn't mean we're immune, but I'd be more worried about risks that we haven't fully thought through, including of late, one thing that keeps coming up is the next financial crisis triggered by a massive cyber attack? Because once you lose confidence in financial institutions because you don't know if they even know how much money you have, you could have a much more pervasive impact on confidence than more traditional mechanisms. So for example, the crash in the stock market, that's exactly one of the major things we're already doing all the stress tests for. The thing that we're already focused on, housing prices and stock market, it seems to me to be something we're best defended for because we've paid so much attention to it. And in terms of insurance and pension funds, I think there we have some significant protection because they're such long-term institutions. There would be problems, and I think in the long run you could have real problems from low interest rates going through to those institutions, but at least the likelihood of a crisis directly from it, I think, is lower. But anyway, my views.
Sure. Okay. So I think the issues around the systemic risk and our measurement around systemic risk is one of the weakest parts of all the regulation that we have. And that, in fact, we could come up, I think, if you look at OFR, they have 31 measures of systemic risk, which means we have no measures of systemic risk. And so I, of course, created a measure of systemic risk. But I created a measure of systemic risk building off of the measures of systemic risk that firms actually have to report already. So using a risk engine, from an enterprise risk engine, aggregated up to a systemic risk engine creating a system of banks. And that actually is one way in which you can have a coherent measure of systemic risk and then test the different types of regulations and their impacts on the system itself. So I'm plugging myself. So I'm plugging anybody who wants that. So I think that's actually a good first step, because when we look at where there is a serious fault or lack of regulation, it actually is exactly in the mutual funds, where every regulator would say, yes, we all have good eyes on the banks. They're well regulated in the sense that people are paying a lot of attention to them, but nobody is on the insurance and in the mutual funds and the pension. That is hugely underregulated in their mind, and therefore they would view that, and that is much bigger part of the of the financial sector, if you will, than the stock market, the banks, or anything else. So if that goes, that really sets the whole place up for failure. But the previous global crisis would have just been seen as a blip. So I think that is a very serious problem, and that is a problem really where you do need to understand interconnectedness, and you really do need to understand the way in which it is affecting multiple counterparties and so forth in a very sophisticated way. If it's not just on an institution by institution, that means stress test level. It's a system-wide test level, and that's I think that's the big thing that we have to move to understand whether we're in safety and soundness mode for this.
Thank you, Sharon.
Yeah.
Gil.
Yeah, so I'd say two things. First of all, for sure there will be additional crisis, and I'll get back to that in a second, but I think the last crisis was different because of how global and how interconnected everything was, to a point where the financial system globally was on the verge of collapse. And I have to say, I've enormous respect for what the central banks and the regulators have done during the crisis. And as a result of that, and you see their work, and you could always argue about this regulation or the other, or this clause or the other. I think they're very mindful of that. I think the system is much better funded, and there is much more mindfulness around the interconnectedness of the system. And I think that the chances of us during our lifetime seeing another crisis of that magnitude, to me, are as close to zero as it gets. There will be crisis, but such a global crisis that can basically really put a risk on the entire financial system, I don't think we're going to see again. I certainly hope not, but I actually believe that it's not going to happen. Now,
That is why you're a Silicon Valley entrepreneur, right?
I prefer to be referred to as Mrs. Watanabe. I think where I do think crisis will happen is there are two reasons why crisis will happen. Well, first of all, crisis will always happen, right? But there are two places where it could. First of all, because of the low interest rate environment, the amount of capital that exists in the market burning holes in the pockets of investors is huge. And by the way, growing every month. And there is just no good investment opportunities, which is a perfect recipe for the next bubble.
Yep.
So somebody will come up with Tulip or internet stock or eyeballs or whatever it's going to be, that will be a new economy all over again that does not operate under new rules, and the money will go there because this money has nowhere to go. So first of all, I think there is a perfect setup for a crisis. The second thing, going back to my prior point, where I think it could happen is, we talk about shadow banking, we talk about all of these alternatives that will grow. They have to grow because the market does need lending. There is a show. So just as a side note, what I do in my new company, and this is not a plug-in, just about what I do. So we're setting up the Airbnb for capital in capital markets, right? Trying to solve this shortage of capital for lending, et cetera, for trading and capital. These things will come up, they will grow, they will come very quickly, they will not be well understood. They will not be run by people who necessarily come from that industry, who have this institutional knowledge, responsibility, et cetera. If you look at some of the mistakes that were done in the peer-to-peer lending space, it's very clear that it's because it was run by people who just, these are not bad people, just didn't have the same disciplines. So my guess is within a reasonable time frame, we're going to see many new entities that are not well understood, taking huge parts of the financial system, and there will be an AIG moment where people are like, well, how did an insurance company all of a sudden become the heart of all those financial institutions? This, I think, is a material risk, and I do expect we're going to see some of those.
Thank you. Annalisa.
Yeah, I mean, your question was how will people react when their pension funds disappear? And I think how they react depends in part on how much of a surprise it is to them. How honest, let's say, we've been with them about what we know and what we don't know, and so if the public has been told that there will not be another crisis, and that we have it under control, and that we have a playbook this time, and we know exactly what we're doing, and then suddenly it turns out that we don't, I think they are legitimate. They have reason to be angry. And so this is only one of the reasons why I think that we really need to have a conversation with the public now about what we can do and what we don't know how to do. and bring them into a more adult conversation about that. You know, this morning we had a moment at which we talked about a statement that the governor of the People's Bank of China made, and we all laughed, and I laughed harder than everyone, about how crazy it seems that he would come out and say that there's a Minsky moment, that he feels that he's on the verge of a Minsky moment. But the question is it really defensible to continue to not tell the public what we see out there? And is it strategically wise? I mean, right now in the US, we're facing a situation in which pretty soon there may be an attempt to roll back Dodd-Frank at sort of by night, right? And if the public doesn't understand what the risk is that they're facing and the limits of what we can do, they're going to be a lot less interested in protecting themselves there. So I think those dangers are real, and you know, there's a lot of, you know, we've seen a lot of positive things that have happened since the crisis. One is the increase in the number of NGOs in this field that do that important translation and outreach work. It's too bad that we don't have more of them here today, but that would be great. The role of journalists, I think, is really important. But so how do we work on that communication now and not after the pension funds are gone?
Thank you. Peter.
I can't resist pressing you all to follow up on Franklin's question, and maybe Franklin himself. All around the world, we've permitted pension regulators to lie about the value of the liabilities with various smoothing devices for the discount rate used to value the liabilities versus the assets. So the lie's already out there.
Right?
It's there right now. We're just not choosing to recognize it because we find it awkward that we've pumped up the asset side and we're not willing to recognize that the value of the liabilities has been pumped up as much as the asset side's been pumped up. So I don't think it's about tomorrow. Now, whether it's a crisis or not actually turns on whether how we go about realizing it and when we go about realizing it. But I feel in some way or another you've all glossed over what we're actually doing right now, we financial experts collectively defined. Forgive me.
Maybe we can collect a few questions and then people can. Should we take that one there?
Just so a couple of quick points that, you know, I've heard a lot of talk about North Atlantic sort of regulation, but we're talking about the future of the global financial system. I don't hear us talking about what buffers or what things we're putting in place at the IMF or other levels to deal with. Your takeaway from the China quote was talk to the public. My takeaway from the China quote was, oh shit, we might have a China problem. And so we have that. We have, if you look at the next 50 years, you know, where is the population growing? Where are people going to be working? Who's aging and who's not? Well, the growth in the world and presumably capital flows will start changing towards India, possibly towards Africa, definitely away from this US European context. What are our international organizations set up to do that, or do we end up in a place again where the Fed, or perhaps next time the Bank of China, is the central banker to the world? The third thing I'd say, and even just thinking about a domestic or a North Atlantic context, coming out of the crisis, we put on a lot of Band-Aids. But I've heard very little positive articulation about how we want the financial system to work. The European system is still predominantly a universal bank-led system. The US system is still predominantly a market-based system. You know, I have heard very little about what is actually the design of the system that we want and how will that system as a whole work. I've heard about are we combining the OTS and the OCC and the Fed regulators together. I haven't heard the larger construct. So just a few points.
Governor Shirakawa at the back.
When we discuss populism and central banks, we have to think of two causality. One is from the politics to populism or politics to central bank, but also we have to think about two causality from central bank to populism or politics. And in this regard, I have two questions. One is, how do you think, how does the handling of financial crisis affect the rise of populism or politicization of central bank? The second is the way in which monetary policy has been operated in the past 10 years or so. It has a tremendous distributional impact. And so without taking this thing into consideration, the discussion on populism or discussion on the relation between central bank independence and populism is not completed.
Thank you. John?
Hi. Going on from the discussion about pension funds, I'd like to ask something about one of the points I considered making earlier. If you want one area where past history may not be a very good guide to the future, I think it's to do with institutional investment. In 1954, in round numbers, about 10% of the US market cap was held by institutions, and all the rest was held by individuals holding shares for their own account. Now that number is the other way around. There's maybe still about as much as 10% held by individuals, but basically the stock market and more or less any other tradable market you care to mention is being traded by institutions managing money ultimately for other people, with all the fascinating principal agent issues that implies. Particularly when it comes to pensions, there's the further issue that they are really, really important. They rule the world. Canadian pension funds rule a lot more than Canada at this point. And they are about more, regulating a pension fund at this point is about more than safeguarding the interests of potential beneficiaries. How then do you deal with the issue of this enormous entity, the institutional asset management industry, that literally, banks have been around for 200 years, they've developed, but they've been banks. I think it's fair to say that the asset management industry arguably didn't even exist before ERISA, certainly hasn't been around as in anything that's recognizable in its current form for 50 years. What do we do about that? And particularly when it comes to populism. During the crisis, there was one example. The Mexican pension fund system is still in its infancy, modeled on the Chilean system. They didn't like the run on the peso, so the Mexican government told all the pension funds to switch back into Mexico, to sell their foreign assets and come back home, which did rather help the peso at a point when it was under a lot of trouble. Does suggest something about, if you want a populist attitude, if you want more populist control, you can decide that the government needs more control over pension funds. And I said it flippantly, but it is actually true. They do rule the world. So if you control the pension funds, you can get a lot of populism and a lot of nationalism done very quickly. Is this an issue? How do you deal with it? Sorry, I talked too long.
So Dick, do you want to take, and then we'll take one last one with Paul.
I'd like to raise a much less cosmic question that I detected in a sort of tension, mild one, between what Sharon said and what Annalise said. Sharon, I think, noted that the procedures we put in place make it very, very difficult for regulators to exercise discretion and provide lots of opportunities for political input. I think Annalise viewed that as a somewhat positive thing because it, in your view, it created an opportunity for a dialogue between regulators and the people. Mm-hmm. I'd like to suggest that it isn't really working that way and that it itself is really causing populism to increase in some modest way. If you look at what actually happens in these comment periods, because regulation has become so hideously complex, the only entities that comment, with very, very minor exceptions, are those that have skin in the game, those that are deeply involved. Now, we should hear from those people because you want to know how the regulations will happen. But we shouldn't lose sight of the fact that they are deeply self-interested. And there is no real representation of the public interest in those forums. The outcome is almost always greater complication in the regulations as regulators try to accommodate the comments of very self-interested people. The rule book becomes crazy in its complexity. Look at Dodd-Frank, look at all of the implementing measures. No reasonable human being who isn't paid to understand this stuff can do it. And so it's not unlikely the public will think it's a broken system, blow it up. And I think it really does feed into this notion that the experts have just sort of spun off on their own.
Okay, one Paul, last question, and then we'll go through the panel again. Paul Tucker.
Thank you. This is for Sharon and Annalise, and I think it picks up in a way on what Dick was just saying. I agree with a great deal of what you both said. Well, Sharon had some facts, so it's kind of hard to disagree with those. But both today and on most other occasions, when people talk about financial regulation, it's kind of all put in one bucket. And I would, given the theme of the conference, I would like to suggest that it's really important, or is it really important, to distinguish between the value of a resilient financial system that won't collapse under some socially agreed consensus level of stress that it ought to be able to withstand, and all the other issues that go on. So the new chair of the SEC wants to strike a different balance between investor protection and capital formation, which are equally ranking objectives under the 1934 Act. That strikes me entirely reasonable, even if I don't personally agree. I don't know which I agree with, frankly, but because there is no consensus about where that trade-off should be struck. But I would like to suggest that it is a widely shared view in society is that the financial system collapsing and having to revert to barter, or having the payment system switch, as happened in the 30s here, or having the payment system switched off, or a kind of violent contraction in the supply of credit. These are things which people in the coasts would like to avoid, and people in the middle of America would like to avoid too. And my question is, could we get to a better place if we were clearer about the distinction between the resilience of the system and all the other stuff, in the way that over the last 30 or 40 years, we no longer look to monetary policy to be the source of prosperity. We just look to it, doesn't always succeed, to provide a platform where resources can be allocated by the market or by government. Would this help?
So let's go in reverse order this time. So, Annalise, do you want to go first?
Okay, sure. So those are all great questions. I'm just going to take a couple of them because I'll let others respond. So to Governor Shirakawa, first of all, it's a great honor to speak for someone who knows much more about Abenomics, obviously, than I ever would. Does central bank handling of financial crises produce populism? It's very hard to demonstrate that or prove that in a social scientific way because you can never show what the cause of a social movement is. There's too many variables. And I think there's also evidence that there are big differences in different countries. The role of the central bank is very different in different places, and its relationship to the nation and then the narrative about its place in the nation is very different in different places. And so I don't think we can say it's always going to be the same everywhere. But I would argue that in Japan, we have seen a change in the political climate as a result of Abenomics. We can decide whether that's good or bad, but a change in the political climate. And I think that there's evidence that it's tracked to Abenomics by the comments that you hear people making, and so forth. And certainly in the United States, I've tried to get at this question by reading a lot of blogs of right-wing nationalist groups and populist groups, and spending a lot of time reading Breitbart and so forth. And when you see the rhetoric, the issue of the bailouts, the big banks, fat cats getting bailouts, comes up again and again as a theme. And so I think the way that's portrayed certainly seems, at least anecdotally, to suggest a connection there. And I completely agree with you that distributive consequences have to be part of the conversation. And while all central bankers know that there are distributive consequences to what they do. I think it's far less at the front of the discussion than it probably should be, right? And if it were at the very front of the conversation, along with other questions like stability, perhaps that would go a long way towards resolving this. So on your question of whether or not these procedures make it difficult to, whether or not these procedures are actually a problem rather than a good thing. I completely agree with you that notice and comment as it currently works is a farce, a nightmare, a complete disaster. But I wonder whether or not these are not levers that already exist that we could begin to work on institutionally to make a difference. For example, at Cornell, we have a project called eReg, which is a platform that's been created to try to collect public comments and figure out what the common themes are in 1,000 individuals who write in, rationalize them a bit so the regulators don't just dismiss them as individual kooks, and put them alongside on par with the big banks that have much more developed notice and comments. And this is just an example, but it's been quite effective in regulation in other areas, and I wonder whether we couldn't just work on that a little bit. That said, there will always be spaces in which the public cannot be involved. And we want regulators to have spaces in which they don't have to answer to the public all the time. And so in those spaces, it seems to me, it's really important for the regulators to simply have legitimacy. There has to be a trust me dimension to this. And the question is, how do we create the conditions for that trust me dimension? Notice and comment can't do it alone. And finally, Paul, I think what you're proposing is the beginning of a conversation. What you're doing is suggesting, look, here's a topic we could talk about, a resilient system with the public, right? And let's divide up the issues, pick one, and actually work on communicating clearly about that. And that seems to me to be exactly what I'm talking about and a great beginning point. So yeah, that makes sense to me.
Gil.
Yeah, so I'm not spending a lot of time thinking about populism, but certainly I think there is a meaningful, and we will experience meaningful democratization of the system. And I think what has been happening post-crisis is a little bit of be careful what you wish for because you might actually get it with those regulations. Those regulations are very complex, but the banks really understand them, the meaningful players in this, they really understand them, they really implement them, and they're really grinding them to a halt. Mm-hmm. And what you lose by that is that the entire system, you could get very smart regulators, and you could get a bunch of bankers, and they all dress with the same suits, and they all get together in the same financial centers in the world. And they can actually, as somebody was using the term design, how do we design the system? They could design the system. And actually designing the system became easier and easier with bank consolidation and fewer regulators and fewer financial centers in the world. And people had this notion we can really design and regulate the system. The problem with all of these regulations and where we're at is the good news is the banks are under control and they probably never collapse again. The flip side of that is somebody else who is probably dressed in flip-flops and shorts and lives completely elsewhere and doing something completely different, doesn't speak that language, doesn't talk to these people, and a lot of the ability for oversight is actually going to diminish. Actually, the largest financial market makers in the world today are not the banks. These are small, highly automated groups in Chicago, in London, anywhere in the world. All you need is a server. Literally, you'd go into their offices. They are operating in shorts and flip-flops, and they have their impact on the financial system is ginormous in terms of behavior, in terms of the quality of prices, et cetera, et cetera. So to me, this is a little bit the topic that we're talking about here is a classic sort of Clay Christensen, The Innovator's Dilemma, right? So if people read the book, which is sort of a Bible, and where I come from, the question is, how do huge companies fail, right? And the issue is not that they're complacent. They're actually hiring all the best consultants in the world. The problem is that they're focusing too much on the same group of clients. So in servers, people wanted, you asked your clients when you were IBM at the time, and and they said we want more memory and we want faster and we want bigger mainframes. But then somebody came in and actually said, actually, I'm going to give significantly less, and it's going to be significantly cheaper, more available, and basically has taken over the industry. And I really believe that I'm not dealing with the populist view, but the institutions that are going to have a massive impact on this industry actually are not in this room. They're not talking to the regulators. They're not known. And this is where if we're worried about the financial, the stability, the conduct of the system, what's going to happen to people's money, et cetera, I'm not that worried about how pension funds that are heavily regulated today are operating. But I'm super worried about the next 1, 2, 3, and 5 that will start coming up, in a less regulated and less pervasive way. We'll start managing tons of the public's money, and then something bad happens. So to me, that's the good. There is good news about democratization of the system, but there are huge risks that are coming with it.
Sharon.
So I actually think that the technology is the way in which you have democratization, and that allows the regulators to be able to regulate appropriately. So in the FinTech Lab, we have the open source risk engine, and that, in fact, gives small, medium-sized firms who can't afford to hire very expensive consultants to be able to download 400,000 lines of C++ code, stick in their data, and produce the types of numbers and reports that they need to do for the regulators. Now, if they have to put in their own stuff and they have to do things like that, but that's the type of thing that they need to be able to do on a very consistent basis. So even though they're not being quote unquote regulators, even the small green banks, even $100 million, the regulators are now saying, we want you to produce these numbers. They have no capacity to produce those numbers. So the guys in flip-flops are going to be asked to produce those numbers. And the question is, are they going to know how to produce those numbers? Are they going to be able to have enough excess capital to produce those numbers? Are they be able to come up with a technology that does produce those numbers? But this is a way actually to allow people to be able to do that and provide a common standard. So I actually think that's really important, because that's important for the market to expand and to service an unserviced part of the market that then can be effectively regulated to some extent, fall under the regulatory umbrella, and that when our pensions, because pensions, you're right, the biggest pensions are the state governments, right? So the people who are asking, those are the most unfunded pensions that we have, and those are completely unfunded, right? They're on fiat money, right? California it's all burning up with the trees, right? So that's a really serious problem, and they keep rolling it over and rolling it over. So to me, that in the United States, that's where the real problem is on the pensions, and that's a government money. Those are governments. Those are state. Those are owned by states and cities and so forth. That's where most of the big unfunded pensions lie in the United States. So I think that's a serious problem. So the next round, I think, of pensions institutional money is going to come from these lesser sources. And I think that's going to be interesting, and you're one of them, right? And you will be regulated. Sorry, I don't mean any regulators to, but that will be the inevitable when just even when you get going. But that's okay, as long as you know and you have the resources to be able to comply in a cost-effective way and they don't keep changing the rules of the game, which drives out all of the players that are necessary. And that, I think, is a problem. That's the lack of resilience, Paul, that you don't want. That's what makes regulation and the system really ineffective, when the regulators change the rules of the game, when the small players that are servicing large parts of the market that are unserviced by the large players are driven out. That's when the system really does become unstable and unresilient, and inresilient, or whatever right? Right? So, and then And also, that has a lot to do with the clearinghouses, but that's a whole nother conversation. But that's the same genre of conversations that would all fit into, and whether clearinghouses are truly adding resilience or really causing enormous amount of buildup of systemic risk. And that's a really big story. But I'm going to pass it on.
Doug.
Okay, thank you. Really great questions. I'm only going to have time to at most answer 2.5 of those. One of the more profound questions was how should the financial system actually be structured? I think you're right. One of my frustrations as a policy person is in the process over the last 10 years of dealing with the crisis, it's actually been very difficult for policymakers to step back and address those questions. Now, there are a lot of very intelligent policymakers out there who understand a lot, but they've been boxed into a position where they've really had to fight fire after fire, and they've been put in a position where politically they needed to do incremental changes. And every country is different, and financial system is so critical that it's got to be embedded in the larger system of laws and values and the larger economic system. So it's a really difficult thing to do, and our policymakers really haven't had the opportunity to step back as you would wish and tackle it. At the same time, that's really fundamentally what we collectively need to do. So I don't know the right answer there, other than perhaps now that we're farther from the crisis and have wrapped up a lot of the initial responses, maybe we really do have the ability to step back and have the long conversations that will lead, hopefully, to more of an ideal system in the different countries. Populism in central banks, of course, I agree with all the previous comments, including implicitly in your question. Of course, actions of central banks have affected the development of populism, both in the volume of it and the particulars of how it's developed. I think the handling of the financial crisis, which understandably had a number of errors in it, clearly angered people. I would agree with you. I see this too. Like, I try to avoid being on call-in shows, but whenever I am, the bailout is the thing that keeps coming up over and over. So you're certainly right to point out that both ordinary monetary policy and QE, for that matter, and the supervisory decisions do have impacts on the political developments and cultural developments that need to be considered. And I agree with the number of comments that have been made here underlining the importance of pension funds, including, I certainly agree with Peter that we ought to use the economically appropriate discount rates. I think it's a little strong to say people are lying about it, because discount rates are actually a really complex analytical question. I've talked to a number of very sincere people who I think have come to the wrong conclusion about it. But I do agree they're important. I do agree they're significantly underfunded and substantially more than as their reported numbers often show. But it's also a really hard problem to deal with, because, as Sharon's pointed out, a lot of this is with state and local governments. Now, none of them are completely unfunded. Some of them are actually quite well funded, but there are plenty that are heavily underfunded. I agree it's a big problem, and I've written about that myself. Once you've got that big a hole, how do you deal with it? And at some level, it's like having other forms of debt, long-term debt. But what do you do when you're a municipality that's deeply in debt with pension and other type of debt? You still want to provide the services that your people need. If you raise taxes too much to cover this, you get an outflow of people. I think each situation has some unique aspects to it you need to consider, but it is a critical issue and deserves even more attention.
Okay, we should stop there. So thank you very much, everybody, for a wonderful session.